Imagine this. You walk into a coin shop with 80 shiny ounces of silver, you lay them down on the counter, and you walk out with just 1 ounce of gold. That's the gold to silver ratio in action. It's a number that has quietly shaped economies, influenced empires, and today it still guides investors looking for opportunities. But what is it exactly, and why should you care? Welcome back to the channel, where we break down money, history, and investing. Today, let's unravel the story of the gold to silver ratio, where it came from, how it's changed, and why it might just matter to you more than you think. Here's the simplest way to think about it. The gold to silver ratio tells us how many ounces of silver it takes to buy 1 ounce of gold. So if gold is $2,000 an ounce and silver is $25, the ratio is 80 to 1. Pretty straightforward, right? But what makes this ratio interesting is not just the math, it's the story it tells about how we value wealth, money, and even technology. In ancient Rome, the ratio was about 12 to 1. That means 1 ounce of gold could get you 12 ounces of silver. For centuries, the world hovered around that number. Fast forward to the 18th and 19th centuries, the US and many European nations actually fixed the ratio, usually around 15 or 16 to 1 under something called the bimetallic standard. Governments literally decided how much silver was worth compared to gold. But once the modern financial system took over and metals began trading freely, that ratio started swinging like a pendulum. Sometimes it dropped as low as 15 to 1. Other times, especially in moments of crisis, it skyrocketed above 100 to 1. These swings aren't random. They reflect supply and demand, mining production, industrial use, and most importantly, trust in money itself. So why do people still watch this ratio so closely? Because it can hint at opportunities. When the ratio is really high, like 80, 90, even 100 to 1, silver often looks undervalued compared to gold. That's when some investors shift into silver, betting the ratio will come back down. When the ratio is low, say in the 30s, that suggests silver is relatively expensive, and gold might be the better buy. Some traders even ignore dollar prices entirely. They just flip between gold and silver based on the ratio, stacking more and more metal over time without ever spending extra money. Right now, the gold to silver ratio sits at around 88 to 1. That's historically pretty high. And that's why many people say silver is undervalued right now. But here's the twist. Gold is mostly treated as money, a store of value. Silver, on the other hand, wears two hats. It's money and an industrial metal. It's in solar panels, electronics, medicine, you name it. That makes silver more volatile, but it also means the ratio could shift in ways we've never seen before as technology changes. At the end of the day, the gold to silver ratio is more than just a number. It's a window into how humanity values stability, money, and progress. Whether you're a stacker, an investor, or just someone curious about history, keeping an eye on this ratio might help you spot patterns and opportunities that others miss. So, what do you think? Is silver undervalued right now, or is gold still the safer play? Let me know down in the comments, and if you enjoyed this breakdown, hit that like button, subscribe for more money history, and share this video with someone who loves precious metals.